So let's look at the kind of the differences between the groups. American Institute of Certified Public Accountants. They make rules for. Now again, they don't enforce the rules, but they make rules for.
Okay.
They make them for everybody. And by the way, even though the government, the PCAOB does a lot of the rules for, they make their own rules. They also will tell the companies, the issuers, that, oh, by the way, you also have to follow these AICPA rules. So the federal government actually tells them, now if there's a difference between the federal rules and the AICPA rules, the federal rules win out, but they are required to follow the AICPA rules. Okay, is it a government agency?
No.
Yes.
Actually, no, they're not. Now they
They're
make
just the club.
exactly. Yeah, they're a club. Yeah, when you pass a CPA exam, this is a club for CPAs. Keep them off the street, Yeah, so they have no government authority. Can they issue or revoke CPA licenses?
I think it's rather interesting that they have no government authority, but it's like the exams are so thorough. There's like so many laws and regulations that you need to know and pass to become a CPA. But like if you're part of the association, it's not government.
Yeah,
kind of throws me off for a second.
Well, and the thing is the CPA that they make is very thorough, and it is aimed at licensing CPAs. So it is CPAs who went through the licensing process making the CPA exam for a licensing process too. But yeah, they have no government, and they'll issue they'll administer the CPA exam. They'll grade the CPA exam. If you fail the CPA exam and you say, I'm going to sue you because I don't think I should have failed, you're not going to sue the state of Illinois. You're going to sue the AIC because they're the ones who graded it. So, there is a separation that I think the states like, that, hey, we're, you can't come back to us. We're not the group that makes the CPA. Mm-hmm. But also that it is very thorough, and anything a state would want is basically in there. So, yeah, and again, any state could say, we're not going to use your exam. It's up to the state to do that. But again, I seriously doubt anyone will, but they could. It's not. Okay, do they register CPA firms? Nope. Creates the CPA.
Yes.
Will they do that? And again, they make rules for issuers, non-issuers, and issuers. However, the issuers are usually covered by the PCAOB, but they require. But non-issuers, it's a little bit looser. But a lot of times, the rules that they make for non-issuers become state laws. So there are sometimes that these will actually become state laws, not enforced by the AICPA, but by the state. Okay, state laws. Oh, here, I have right here, many based on CPA rules. Okay. They make laws for both non-issuers and issuers. Just because you are an issuer does not mean you don't have to follow the state rules. If they have laws that you need to follow, then you need to follow them. Are the states a government agency?
Yes.
Yep. They issue and or revoke licenses.
Yes.
Yep. Register CPA firms for issuers. No. That's what the PCOB does. These people down here. Creates a CPA exam.
No.
Yeah, CPA creates it. They tell people that they have to take it to get licensed, but they do not create the exam. Okay, so state laws. Okay, PCAOB. They make laws for. It's only one of them.
Just the public?
Yep, exactly. Just the issuers. If you're private, Jenny's hot dog stand doesn't matter. They have no power over you. If you're IBM, they have power over you. Is a government agency.
Yes.
Yep. Yep. They are a public agency. They have the power of I don't say life and death over companies, but they have quite a bit of power over companies. Do they issue or revoke CPA licenses? Nope. There's only one place that does that. That's the states.
No.
They do not do that. They register CPA firms for issuers.
Yes.
Yep. Yeah. So if you want to do audits of publicly traded companies, you have to get registered with the PCAOB. Create the CPA exam. That's what our club does. Okay, so these kind of so the big thing is states are the only ones that can issue or revoke licenses. The ACCPA has no official regulatory authority. They're not a government agency. They can kick their own members out. If you're a member of the ACCPA and you do something crazy, they'll kick you out. But other than kicking the members out, there's nothing they can really do. They can't take your license. They can't revoke your registration or anything else. Okay. You know what? I'm going to stop here. Oops. Okay, auditors only look for material misstatements. And that's no matter what they're doing. Man, we talked about this before, but material misstatements are the only thing they're looking for. They're not looking for all misstatements. They're not looking for make sure everything's down to the penny. They're only looking for material misstatements. Again, this is one of those things that the public kind of has a different idea than what actually happens. So they're only looking for material misstatements. So those things that would be material to the average investor. Now that's a judgment call, but that's basically what we are looking for. And it doesn't matter what area we're talking about. It could be a misstatement due to legal problems. It could be a misstatement due to whatever. We're only looking for those things that are material. Okay. What is the difference between an error and fraud? What is the
Error
difference?
would not be made on purpose, and fraud will be made on purpose.
Exactly. An error is unintentional. It's made by accident. It's not made on purpose. Fraud is. So we're only looking. So basically, we're looking that it was. An error is going to be an unintentional misstatement. Whereas a fraud is an intentional misstatement. It was made to deceive. So this has an element of deception. Mistakes are not illegal. Fraud is. This is a fraud is an illegal act. So, and by the way, when it comes to prosecuting people for fraud, that's always that's the biggest sticking point, is whether it was unintentional or intentional. And it's hard to prove, and sometimes it's hard to prove whether it was intentional or unintentional. How do you say, well, how do you prove that it was intentional? One of the things they look for to see if it was intentional is, did somebody try to cover it up? If somebody tried to cover it up, then they knew about it. They knew that it was wrong and they were trying to cover it up. So anytime someone tries to cover it up, that's a pretty good evidence that there was an intent to fraud. But unintentional, somebody making a mistake, that's not fraud. It does happen, but it's not fraud. Okay. Type 1 fraud. Type 1 fraud. Oops. Okay, type 1 fraud is when an intentional misstatement appears on the cooking the books. So this is a second here. So cooking the books, making the company look better usually than it really is. Type 2 fraud is kind of, the wording of it's kind of funny. This is misappropriation of by employees. This is theft. Let me change that. Employee theft. I like the term misappropriation of assets, but that's taking it. Oh, actually, I just say type 2 fraud is. I gotta clean it up again. Okay. So we have type 1 fraud is cooking the books, an intentional misstatement of the financial statements. Type 2 fraud is misappropriation of assets. I love the word misappropriation. It's such a nicer word than theft of assets by employees. By the way, which fraud are the auditors more concerned about? Type 1 or type 2?
Type 1?
Yep. Yeah, auditors are really worried about type 1, the misstatement of financial statements. That's what you sign that report, that report we talked about last time, that it says that we're reasonable assurance about whether the financial statements are free of material misstatement. that's where, so we're talking about the financial statements, and we're not, if the financial statements aren't misstated, we're fine, even if there is some fraud evident. But so we actually sign off on the financial statements that, reasonable assurance about whether they're free of material misstatement. Okay, so type 1 fraud, what we're more concerned about. Type 2 fraud is not that we don't look into it, but it is only if it's material. So if someone steals, $100 out of petty cash, it's not a good thing, but as far as the audit's concerned, petty cash is by definition immaterial. We're not going to report on that. If we ran across it, we would let management know about it, but we're not going to be looking for it. So we're only looking at those things that are material. And then when you get to the larger companies, and you talk about the multi-billion-dollar companies, it's really hard for one person to commit enough of a fraud that it would cause a financial statement to be misstated. Someone could be stealing $100,000 a week from Walmart, and it would be absolutely immaterial. $5 million a year, whatever, immaterial. So, it would take a lot of theft to make it material for something like Walmart or any of the larger companies that are multi-billion-dollar companies. It's almost impossible for individuals to actually create that stuff. So we are focused more on the financial statements and what they are. Now, but that brings up a good point, though, in that we're always only looking for things that are material. Okay, so when an employee, even if they are committing a fraud and stealing or whatever, if it's not material, it's not really our problem, and we're not going to be looking for it. And again, we're always looking for those things that are material, not things that are immaterial. So, if we find them, we run across them, we usually tell someone to manage, oh, by the way, there's, $80,000 missing out of cash. It's not material. We're not going to do anything with it, but you should probably know. We also don't investigate those things. We run into fraud. We generally don't. It's not up to us to investigate that. What we do is we tell upper management about it, and I'll talk about this in a second. You tell upper management about it, and they should act on it and figure out who did it. And that we don't start our own investigation while we're in the middle of an audit to figure out, who to blame and all that kind of stuff. Let me go back to the. Okay. Compliance with laws, illegal acts. Now, again, we're only looking for those things that are material. Okay, direct effect. Oops. Let me put it. Illegal acts have a direct impact on the financial statements. Important to the auditors. Let me clean this up a little bit. And I'll give you an example. Okay, so illegal acts that are, before I. Example, tax evasion. Tax evasion, because that will have a direct impact on our tax expense account. That'd probably be a better way for me to. Okay. So if their illegal act is tax evasion, well, that has a direct impact on the tax expense account. Well, now we're more interested in this tax evasion. It's an illegal act, and there's a direct effect on the tax expense. So those things that have a direct impact are more important to us as auditors. Other laws, indirect impact. Illegal acts that have an indirect impact. Oh, what do I mean by that? Are of less importance. Example, environmental protection fines. Oops. This is a illegal acts. Wait a minute. That's right. Okay, so environmental protection illegal acts. So let's say you have something that their client, you find the client is doing something, they're doing something illegal when it comes to the environment. Maybe they're not disposing of something properly or something like that. So environmental protection. Now you might say, well, wait a minute, couldn't they get fines? Yeah, they can sometimes. Sometimes they get fines. Sometimes the EPA just says knock it off. It's hard to tell what because it's not direct. It isn't like we didn't report this income and there's X amount of dollars that are going to show up on the financial statements. You don't know what it's going to be. Again, it could be a fine. It could be stop doing this. Whatever it is. You don't know what the impact is. So we're less in tune to those things because first of all, it's unknown, and a lot of times it may not be any financial impact at all, even though it is an illegal act, or it might be something trivial, not trivial, immaterial. Someone has a zoning problem or something like that they have may have a fine of $1,000 or something. You don't really do much with that. Okay, responsibility for detecting illegal acts, same as anything else. We only look for material illegal acts. We do not look for all illegal acts, only material ones. And if they're not material, we don't look for them. Okay. Responsibility for reporting the illegal acts. So the question comes about, what happens if you find an illegal act? What do you do with it? But illegal acts covered by the auditors, it should be reported. To upper management and board of directors. If they have, and if they have an audit committee, the audit committee. Audit committee is part of the board of directors. So if they don't have an audit committee, report to the entire board of directors. Okay. Important note. Auditors generally do not investigate the illegal act. So you find an illegal act, you don't do the investigation. Investigating illegal acts is a separate activity by itself. You're reporting to the board of directors and the upper management and the audit committee. If it involves upper management, you're not going to include them. You're just going to go to the board of directors or audit committee. But the auditors generally are not the ones to do it. So some say if you read a CPA question, it'll say, okay, we find the illegal act. You perform an entire audit of the to find out the illegal act, who did it, and all this kind of stuff. You give it to upper management if they're not involved, board of directors, audit committee. You report it up to them, and they should act on it. So you don't actually do that, that investigation. I'm going to put one more thing in here that's actually can be very important. Another note. Wow, look at all these notes. The editor should not the editor should not accuse anyone of an illegal act that has not been proven in a criminal court. Okay. This can lead to a civil lawsuit. For slander. Okay. So you find that a clerk has been stealing from your client. A clerk is working in there. You find out that that clerk is stealing. You give all the information to the client. The client is required to look into that and to figure out what's going on. You do not say that that clerk is stealing funds or is committing a fraud or anything like that. If they have not been convicted in a criminal court, you're accusing them of a crime that they have not been convicted of. They can sue you for that. This way you can't say, oh, this guy, this person's a murderer or something like that. And if they haven't been proven in a court of law, you can't do that. Well, I get you can do it, but you get sued. And you'll see sometimes and say, well, this company caught this guy committing embezzling money, and he turned around and sued the company and won. Like, yeah, they said he was embezzling, and he was never convicted of embezzling. Absolutely he won. Until it's proven in a court of law, in the criminal court. Another thing you say, well, I know when that person sues me, I'll prove that they stole the money. There's a difference between a civil court and a criminal court. Civil court is you're suing for dollars. That's what slander is. No one's going to jail on a civil trial. Okay. You cannot get a criminal verdict in a civil lawsuit, in a civil file. So you can't. There's no way you can get a criminal in a civil lawsuit. There's no way you can get a criminal designation on that. So the easiest thing is just not to do it. Just state the facts. $105,000 was missing from whatever. Give it to the client. Let them investigate it. Let them, if they want to take it to the police, they can take it to the police and get a criminal. If the police will take it, if an attorney, the district attorney, whatever, will take it, it'll get possibly a criminal conviction. But until that happens, you do not accuse anybody of a crime. Just for your own, they can sue you, and if you actually did that, they will prevail. So don't accuse anybody of a crime they have not committed. And generally, I've actually written up for people who were let go. You just write out the facts. Here's the facts, for this person. I never put their name in the report or anything else. And say, here's what was found on this expense report or whatever it was. So don't ever accuse somebody of a crime that they has not been proven in a criminal court. And you cannot prove you can't get a criminal conviction in a civil court. Civil lawsuits are only for dollar amounts. Okay. Types of audit reports. Okay, the first one is the best one. Is the unmodified report. It has different names. Sometimes called the standard report, clean report, unqualified report. So the best is, and this is when we believe that it is, do something here. Real assurance that the financial statements are free of material misstatements. In other words, we don't think that the financial statements are materially misstated. They are fairly presented. And not misleading. So that's the best report you can get is an unmodified report. Sometimes called the standard report, clean report. Unqualified, this is what the they call it for the for issuers, sort of publicly traded companies, they'll call it an unqualified report. What they mean by unqualified, I know the term unqualified seems like a bad term, but what they mean by unqualified is that, everything's okay and I'm not going to put any qualifications on it. I'm not going to, for instance, here's my phone, the phone's great, except that it doesn't answer phone calls or whatever it is, that's a qualification. So an unqualified report means, here's a report and we're not going to tell you anything else. You can rely on it. It is, it is not materially misstated and so on. So unqualified, well, that sounds like a funny term. It actually just means that we're not going to add anything else to it. And so this is the best report to get. Most companies get these reports, and I'll tell you why in a minute. But these are the best. Okay. The next best. Second best. This is when this is a qualified report, sometimes called a modified qualified, and sometimes called an except for report. So I'll talk about in a second. Okay. Qualified report. Oh, wait, I didn't put a parenthesis around those. Okay. Qualified report. Qualified report means that there is a material misstatement exists. But it is not pervasive. In other words, the financial statements as a whole can be relied upon. Usually one or two accounts are impacted. Okay, so let me, okay, so not pervasive. It's not throughout the entire financial statements. It's only one or two accounts. And the financial statements as a whole can be relied upon. Or that they are, as a whole, are fairly presented in a way. Okay. This is commonly called an except for. Kind of a funny reason. So a qualified report. The reason why except for is, they call it an except for, is because it'll say, hey, everything's fine, except for, and then it tells the bad stuff. So oftentimes they're called an except for opinion is everything's okay, except for, and then they tell you whatever's bad. It's not so bad the financial statements are not fairly presented that they can't be relied upon. However, there is a material misstatement in there, or a question about a material account in there. And again, this is usually when it's isolated in one account, or that it's not throughout the entire financial statements. it doesn't have anything to do with, income and revenue and cash and all this kind of stuff. That it's usually there's something that's material, but it is not throughout the entire financial statement. So these are commonly called an except for, and that is the qualification. The qualification is, everything's okay. Here comes a qualification, except for, now it's a qualified report. Okay. So you get the unmodified, qualified, the worst opinion. I'm gonna make it in capitals, big angry capitals. The worst opinion. Oh, an adverse. Oops. Forgot how to type here. Okay, the worst opinion is an adverse opinion. I put report in here. Okay, adverse report. This is when material misstatements, could be more than one, exist and are pervasive throughout, has an R in it, in case you're wondering, throughout the financial statements. These are also called not GAAP. They don't follow the rules. They cannot be relied upon. So these are the worst. This is the worst one you can get. Okay. Now I want to talk about something about the kind of the similarity between the qualified report and the adverse. Okay. For this one, oops, forgot an else. The misstatement is known. What I mean by that is we'll say, okay, these are misstated by whatever. So we give a dollar amount. And we'll put it right in the report. Same thing for the adverse opinion. Whatever it is. So for B and C, we know how much it's misstated by. And we'll put it right in the report. So if it's a qualified opinion or an adverse opinion, when we find that it's something misstated by whatever amount, it goes right in the report. This is misstated by $50,000 or whatever it is. So think about this if you're talking with a client. Generally speaking, you don't want to give them a qualified report or an adverse report. What you want them to do is make the financial statements, not materially misstated. So one of the things about these two reports is you tell the client, look, either you change this or you're getting a qualified report or you're getting an adverse report. And it's going to have, you're not going to hide this from anybody. It's going to be right in the report. what these are misstated by. It doesn't do the client any good not to correct the financial statements. And you want them to. It isn't like you surprise them at the end and give them an adverse opinion. You talk to them and say, look, you got these sales here that, these aren't really sales. You got to take those out or else you're going to get an adverse opinion. If I give you an adverse opinion, it's going to go right in the report, and anyone who reads that report will know that you're basically putting out fraudulent financial statements. It's going to be a double whammy. Not only they know that your financial statements are misstated and how much they are, but they're also it looks like you're trying to deceive people. So there is no good reason why a company would get there actually is a couple situations where you could possibly get it qualified, but certainly an adverse opinion, there's no reason why you'd ever have one of those, because it's going to be in the report anyways. You might as well make the changes in the financial statements and get a clean report is much better than getting an adverse opinion that tells how much they're misstated anyways. Now, do adverse opinions happen? Yeah. You get people pounding on tables saying, you got to change this, and then someone else pounding saying, I'm not going to change it, and then they get an adverse opinion. And again, it's the worst thing you can do, because it also reflects on the management of the company that, hey, they're not being honest about reporting. So there really isn't a good, qualified adverse opinions. They're very rare for that reason. And even if the client doesn't agree with it, they probably will make the changes just so they don't get an adverse opinion or even a qualified opinion. So those two, we know the dollar amounts. We put it right in there. We put it right in. Here's the dollar amount. There's $4 million of assets here that don't exist. So it doesn't do any good to get a qualified adverse opinion. So these are really pretty rare. Okay, the last one is kind of wacky. And this one is what I'll say is unknown. And this is a disclaimer of an opinion. So it's called a disclaimer. And this is no opinion. Okay, so when does this come about? The auditors are unable, enough evidence to form an opinion. The misstatement, if any, is unknown. So a disclaimer is that auditors are unable to gather enough evidence to form an opinion. And this can come about a few different ways. It could be that the client's records are just not adequate enough to actually do an audit. Now, hopefully, that you'll spot that early on if you can't give an opinion. But if their records are not good enough, I met a guy that was doing an audit one time. This guy called him in to do this audit. He was a construction kind of contractor guy, and he had virtually all his transactions were done in cash. Which is really hard to do. You're talking about thousands of dollars, and most of them were done in cash. And it was just the way the guy operated. It wasn't, he said he didn't think the guy was actually doing anything wrong, but as far as an auditor is concerned, if everything's done in cash, you have no paper trail. Someone comes and drops off cement and you hand them cash. There's no check coming back from the bank. There's no invoice. There's no, there's nothing to do, to compare this to. And then and the guy was actually, fairly successful, but again, he didn't have a paper trail. So that's one of the reasons it can be. It can come about, suppose they have a computerized system and, what happened? If someone came in and broke in and stole all the computers with all our information on it. Oh, okay. But you have backups, right? Yeah, we have backups. Where are they? They're in the safe. Oh, where's the safe? Well, they took the safe too. You can't get the information. It can also come about if a client doesn't allow you to get the information. One of the things we have to do is contact the client's lawyers about any lawsuits and that might impact the financial statements. And if the client says, "I'm not going to let you talk to my lawyer," if you can't get the information you need, you can't get the information you need, and they get a disclaimer. And a disclaimer, there's no dollar amounts. If they do put dollar amounts, they'll say we don't know about these dollar amounts. So a disclaimer is really no opinion, and it doesn't do anyone any good. It's like handing them nothing. A disclaimer is like nothing. Here's nothing, and here's my bill. So a disclaimer is also not desired, but it's unknown. It might be misstated, it might not be. You just don't know. Okay. Let's see how this all plays out. All right. Number 8, the auditors were unable to verify significant investments made by their client. Which report would be appropriate for this scenario? Anyone?
For 8?
If they're unable to verify these investments, they can't get the information on them. So yeah, disclaimer. A disclaimer of opinion. We'll talk about a little later, maybe that it is possibly going to modified. We'll talk about it in a minute. The auditors determined that cash, inventory, and revenues. Yep, you're right. There you go. The auditors determined that cash, inventory, and revenues were all materially misstated. Which report would be appropriate? Which one do you think?
Is it B?
It could be B. Because this is actually this is the balance sheet stuff, and this is an income statement. Most likely be C. Did you say C? I'm sorry. But it's possible it's B. It depends on how pervasive it is, but it is possible that it could be B. But because it's in several accounts, and one of them being cash, and then also revenues, it probably end up with an adverse on that one. It's a judgment call, though. It depends on I didn't give you the dollar amounts or anything like that. So, all right, how about number 10? These are all immaterially misstated.
Would that be B?
Nope, probably not. They're immaterially misstated. So they're misstated, but not by a lot. Not enough to make a difference to anyone.
A?
Yep. Yeah, that'd probably be A. So we don't say the financial statements are not misstated. We simply say they're not materially misstated. So if they're immaterially misstated, which quite honestly most statements are, they are they get an unmodified or unqualified report. Number 11, this one's a little bit tricky. The auditors were unable to verify a material amount of off-site inventory on a client's books. None of the other accounts were materially misstated. The auditor would report the appropriate, which audit report would be appropriate for this one? So it's a material amount. Oops.
Would this one be B?
Yeah, most likely be B.
That's like the except for it.
Exactly. You say, look, everything's okay except for this off-site inventory that we were unable to verify. If it was significant enough, you might give them a disclaimer, but usually, that's going to be a modified report, even though it is, it's unknown because it's concentrated on one account, and even if that account was misstated, it would probably end up being a modified report. If it was misstated completely, it'd probably end up being a modified report anyways. So in this case, even though you can't verify it, even if you took the worst case scenario, you'd probably end up with a modified. Okay, why are qualified and adverse opinions rare?
Okay.
Could be, but you know what? I didn't tell you one more thing.
Is it C?
Um,
I'm sorry.
no. Qualified and adverse opinions are because they include the misstatements. They'll actually include the misstatements in the amounts. So qualified and adverse opinions. Here. Let me show you. Back up here. Because these are known and they're put right in the report itself, the misstatement is actually shown in the audit report. They're not going to hide, they're not going to be able to hide it. So if you find a misstatement that it's fairly rare that they will not go ahead and change it.